We will start with the presentation from our expert. We have two experts today from Ernst & Young. And after their presentation, we will take questions from the audience. So the whole duration will be around 1 hour. So by 4:55, we should be able to wind it. So, and also request to all, keep yourself on mute and keep your cameras off so it doesn't disturb the presenter. After the presentation, you can unmute yourself and ask questions directly, or you can also post your questions in the chat box. We will take that questions from there. So let me start. Before I begin the webinar, let me share a few slides explaining to the viewers about smart manufacturing and enterprises. Hope the screen is visible to everybody.
Yes, sir.
Yeah, thank you. So Smart Manufacturing and Enterprises is a 52-year-old brand. And earlier it was known by Industrial Product Finder. Every month we get around 1 lakh readers through its website and the magazine. With India emerging as a major economic power in the world, Smart Manufacturing and Enterprises covers every aspects of manufacturing segment, right from latest technologies to government policies to business strategies. The magazine offers an assortment of news, views, interviews, and well-researched articles. SME is widely circulated to manufacturing and engineering sectors such as automobile and auto components, electrical electronics, metalworking, machine tools, process industries, plastics and packaging, defense and aerospace, and general engineering industries, among others. We have presence in all major cities like Mumbai, Delhi, Kolkata, Bangalore, Chennai, Coimbatore, Ahmedabad, etc. Smart Manufacturing and Enterprises is published by ASAP Info Global Group, which also publishes magazines such as Indian Textile Journal, Construction World, Equipment India, Indian Cement Review, and Infrastructure Today magazines. ASAP Group also hosts conferences and exhibitions such as India Construction Festival, Cement Expo, 3i Expo, Rasta Expo, Infrastructure Today Conclave. Coming back to today's webinar. So, despite global economic remaining under the grip of uncertainties, India's economic growth continues to shine, driven by domestic consumption and better than expected exports market in the last quarter of FY24 and the first quarter of FY25. Against this backdrop, Finance Minister Nirmala Sitharaman presented her 7th straight budget on July 23rd for the fiscal 24-25. This was the first budget by the BJP-led NDA government since it was re-elected in June. With emphasis on infrastructure, skill development, and MSMEs, the FY25 budget aims to drive India's manufacturing-led economic growth. But what this initiative means to industries, and in particular to SME, that is small and medium enterprises. In today's webinar, we will try to decipher the short and long-term impact of budget. And to do that, we have two experts, Mr. Neeraj Menon, Partner Tax and Regulatory Services, Ernst & Young, and Mr. Manoj Rathi, Partner and Tax Regulatory Services, Ernst & Young. So with this, I would just stop my presentation. So on behalf of Smart Manufacturing and Enterprises, I would like to welcome our two guests. And with this, I would hand over the platform to Mr. Manoj Rathi and Mr. Neeraj Menon. Over to you, sir.
Thank you, Rakeshji. Thank you for having us. And thanks to the entire SME team.
So let's quickly get started with the proceedings. Neha will share the slides. Now, as you rightly mentioned, this budget was presented in the pretext of some very, very strong themes running in the backdrop. And some of these themes, globally make us think that, inflation was one important consideration. Global GDP growth, was still subdued between 3 and 3.3%. And as against that, India, continued to maintain that golden spot, when it comes to strong GDP growth, very strong fiscal discipline and strong policy measures which resulted into large global corporates announcing make in India initiative related investments and so on and so forth. We'll turn the page. How we want to run today's session is really quickly talk about some of the macroeconomic parameters. Then we want to touch upon some of the specific policy announcements on which have an impact on MSME, and then we want to focus on the tax proposals. I'm a tax professional, specializing on direct tax, and then my colleague Neeraj will come in and he'll walk us through some of the indirect tax proposals. Though we are tax professionals, we thought it's a good idea for this group to also look at some of the policy announcements, which is why we before the tax proposals we intend to cover some of the key policy announcements. Quickly turning the page and giving a perspective on what the broad macro economic parameters are. So if we look at the overall staging where India stands vis-a-vis the globe, the table on the right hand side will give you an overall view of how the global average for GDP growth, between 23 to 25 has been between 3.3, 3.2, and 3.3%. And as against that, if you look at a cut only for the advanced economies, that's about 1.7, 1.8%. And the emerging markets or developing economies was 4.4 or 4.3%. And as against that, for the last couple of years, India continued to maintain that bright spot on the overall GDP growth. FY24 was closed at 8.2%, which was phenomenal, given the global headwinds, the geopolitical challenges that all of us saw, specifically in some of the markets which significantly disrupted the supply chain and so on. So GDP growth is one strong parameter, and for the next year, the economic survey has projected a 6.5 to 7% growth, which in Finance Secretary's own acknowledgement is slightly conservative because they don't want to put ambitious numbers in the budget and not achieve it later on. So, but they in all likelihood, they'll beat these budgeted estimates on GDP growth for FY25 as well. The important parameter that needs a bit of attention is on the fiscal deficit. We've been through some tough time, globally, because of COVID, and that was the year in FY21 when the fiscal deficit hit all-time low of 9.2%. And from there, in FY24, we closed that year at 5.6%. If you look at the interim budget, the vote on account budget that was presented before the elections, for FY25, the projected fiscal deficit was 5.1%. As against that, the revised budget that was presented after the election, it was brought down to 4.9%. So a 20 basis point reduction in fiscal deficit, which is a strong sign of India's balance sheet. And a lot of that also is to do with the dividends that the government got from the RBI and the government's continued focus to invest on capital expenditure, which has a ripple effect in the economy, creating more jobs and so on. So these are two parameters which look very, very steady, very healthy as far as India's overall outlook is concerned. We'll turn the page and quickly touch upon some of the important policy announcements. Now, thematically, when we look at this budget, there are two important beneficiaries from the budget, and first of which has to be the MSME sector. Now, MSME sector, there are a lot of policy announcements which are in continuation of the past focused benefits which were earmarked for MSME sector. And most of these now will transpire into actual benefits with specific schemes to be launched. But right from credit guarantee to expanding the base on credit assessment to ensuring that the MSME sector gets the right support, on the credit side, Mudra loans, traders onboarding to ensure that there is faster conversion of AR into actual cash, horizontal expansion of SIDBI branches, and so on and so forth. So a lot of policy measures announced there, and what one needs to do is ensure that there is follow through scheme launched quickly with the right stakeholder consultation, so that the MSME sector really ends up getting the benefit from these schemes very quickly. Turning the page, the other important beneficiary from this budget was around employment generation, because that's the other central theme that we've had. So if you see some of the other policy announcements, there are multiple new employment linked schemes that have been announced. Again, these are announcements at this stage, and detailed schemes are expected to be rolled out. But clearly, there is a lot of focus on ensuring that the government takes the right steps, creates the right fiscal stimulus for employers and for employees to enhance and create more employment opportunities. So I'm not getting into the details of each of these schemes, but whether it's scheme A, B, C, which can collectively apply to a lot of employees. A and B will apply primarily to employees which are new in the PF world. So new entrants in the EPFO records is where scheme A and B will be relevant. Scheme C will be relevant across whether or not you're adding new employees to the PF world or not. And then the apprenticeship scheme, which was more around the internship, which was also announced in the budget speech. So that's another important announcement in the budget from an employment perspective. A lot of measures on ease of doing business, whether it's Gen Vishwas Bill 2.0, horizontally expanding the NCLT coverage and so on. So that's one continued focus area. Being a tax professional, what caught my attention was the announcement in the budget speech around doing a comprehensive review of the income tax laws, and the committed timeline there was 6 months. Now, whether it's going to be a new direct tax code or a complete revamp of the existing income tax law, one needs to wait and watch. And likewise, there is announcement to review the rate structure on the custom side as well. GST no is complete overhaul anyways on the other indirect tax regulations, but customs, there is a commitment to review the rate structure and ensure that there is a reset button that is pressed, and more simplicity, more certainty is really brought into the law. So these are some of the key policy announcements that we thought we should quickly get started with to set the tone for today's session. And now we'll just turn the page and get started with some of the direct tax proposals. I'll start with the key individual tax proposals. There is change in income tax slab rate, but only under the new regime, and which will collectively result into a tax saving of 17,500 for people opting for the concessional tax regime. Likewise, for concessional tax regime, the standard deduction is increased from 50 to 75,000. That's another important announcement. The contribution from PA on the pension side is proposed to be increased from 10 to 14%. Again, only for the concessional tax regime employees or individuals opting for concessional tax regime. The other important announcement which impacts and positively impacts individuals is the mechanism to offset TCS that one really faces today on specific transactions, whether you are doing a foreign tour package or doing a remittance under the liberalized remittance scheme. From an exchange control perspective, the TCS that gets collected by the authorized person in between was not previously allowed as a credit against the salary TDS. One was required to file the return and take that as a credit, and wherever necessary, claim that refund in the return. Now there is an enabling mechanism to ensure that you get the credit for such TCS which was collected through the year. You can report it to your employer, and you can get the credit. Likewise, for reporting of foreign assets, the monetary limit is increased from 5 lakh to 20 lakh to bring in some of the penal consequences for non-reporting. We'll turn the page now and look at the other big announcement in the budget. Sorry, we'll quickly cover the individual slab. This is just a continuation of the point that we made earlier. On the individual tax for the concessional tax regime, there are three slabs which are tweaked from 3 to 6 lakh, which was previously 5%. Now it changes from 3 to 7 lakhs. Then the 10% slab, which was previously 6 to 9, now becomes 7 to 10, and so on and so forth. So these are some of the changes that one needs to keep in mind. No changes, like I said earlier, in the original or the conventional tax regime for individuals, and no changes in the overall surcharge rate. We'll turn the page and look at the big announcement, which was made in the budget, which is around rationalization of capital gains taxation scheme. So there was a long-standing demand to rationalize and simplify the capital gains structure, and to a great extent, there is good work done in this direction, especially with the announcement and the changes made, in the finance bill while the budget was passed by Lok Sabha yesterday. So, no, overall, previously there were 12, 24, and 36 months as the qualifying period for an asset to be regarded as a long-term asset. Overall, 12, 24, and 36 continue to be the parameter. Now, 36 it used to apply in many cases. Now, 36 months as a parameter will apply only for one case, which is transfer of business as a slum sale under Section 50B. Except for that, every asset that is listed, if that asset is transferred after 12 months, that is the qualifying limit for the asset to be regarded as a long-term capital asset, and everything else other than a listed asset will be regarded as long-term if it is transferred after 24 months. So from a simplicity perspective, there is good work done in this direction to put things in better perspective from a taxpayer compliance point of view. We'll turn the page now and look at what are the changes to some of the rates on the capital gains taxation. So, short-term capital gain on listed equity shares or listed REITs or InvITs or equity-oriented mutual funds till 23rd July used to be 15%, and it is proposed to be increased to 20% now. Uh, Short-term capital gain on transfer of other assets continues to be taxed at applicable slab rate for the taxpayer, and there is no change there. Long-term assets, long-term capital gains for these listed assets that we spoke of was previously 10% without indexation up to exemption of 1 lakh, which now changes to 12.5% without indexation, but with an increased exemption of 1.25 lakhs. Any other long-term capital gains, 20% with indexation benefit was the regime till 23rd July, which now changes to 12.5% without indexation benefit. And again, on this one, there was a huge uproar after 23rd July when the budget was presented, especially around how the law will work vis-a-vis immovable property, because immovable property which was brought before 2001, there was a lot of representation made to the government, and the government finally brought in a change there. When the bill was passed by Lok Sabha yesterday, what they've done is they have grandfathered property obtained acquired before 23rd July. So now the taxpayer will have a choice to make an assessment between the regime that was prevalent before 23rd July and compare it with the tax outcome for the regime which is now proposed after 23rd July, and whichever suits the taxpayer, that choice can be made. One other amendment which was made by Lok Sabha yesterday when the finance bill was passed was the benefit of first proviso to Section 48. And this will come into play typically for foreign companies, where foreign companies holding shares in an Indian company. The previous regime, or the way it was appearing when the budget was presented was first proviso to Section 48 allows the exchange fluctuation benefit to the foreign taxpayer while computing the gain. But if a gain is derived, then that gain so calculated needs to be ignored, and one was looking at Section 112 to directly import the rate and apply that rate as such without the benefit of first proviso. Now, after 23rd July, the way the provision read was that benefit was being available, and the applicable tax rate as per Section 112 will straight away get applied. And that point now has been clarified by the or rather clarified, or very very clearly stated that benefit of first proviso to Section 48 shall not be available where it has been specifically taxed from 112 perspective. So that's another important change that was presented, that was made while the bill was passed by Lok Sabha yesterday. We'll turn the page and quickly look at some of the other changes which impact the foreign taxpayers. Now, there's no other change in the corporate tax rates as such, except for foreign companies, where the rate is now proposed to be reduced from 40 to 35%, and there is resultant rate in the effective tax rate, which currently is 42.43 for foreign companies having income between 1 to 10 crores to 37.12, and 43.68 to 38.22 for companies having foreign companies having income of more than 10%. Now, sorry, more than 10 crore. Now, one question that also comes up is, when is it that foreign companies actually end up paying tax at 40%? Now, this tax of 40% is not used very, very regularly, because foreign companies end up paying tax in India on specific income streams, either under Section 115A of the domestic law or under the tax treaty. This rate of 40% really applies only where the foreign company has a branch in India or has a notional presence in form of a permanent establishment in India. So for those cases, there is a relaxation of more than 5% in the overall tax rate that is proposed to be made. The other important announcement is equalization levy, which was introduced in 2020, is proposed to be abolished. This is the 2% equalization levy that was introduced on e-commerce supply of services, which is on the online transactions, not the earlier 2016 equalization levy, which was introduced on online advertisement and similar services. So that 2016 equalization levy continues. It is the 2020 equalization levy which brought in a 2% tax on online transaction, involving a non-resident. I think that is proposed to be abolished now. We'll turn the page and look at the other big amendment that is proposed on how buyback uh, of shares is taxed under the income tax law. Now, conventionally in India, we've had a regime where when a company buys back the share, the the incidence of taxation of that transaction is on the shareholder. But this changed many years back when the government at that point in time introduced buyback tax on the company. So the company buying back its own shares was required to pay buyback tax, and that's how the mechanism was working for a number of years. They've changed it back now to move the incidence of tax back to the shareholder, but in a different way. The way it is now proposed is buyback tax will no longer be payable by the company undertaking the buyback. It is the shareholder who will end up paying the tax. The amount that the shareholder receives as pursuant to buyback will be taxed as dividend on a gross basis. But the cost of acquisition for the shareholder will be allowed to be carried forward as a capital loss. So there is a very interesting way how this has been conceptualized here. And again, this is another provision which did invite a lot of criticism, because what it seeks to do is it requires the shareholder to immediately pay tax on the entire amount that he receives from the company as buyback consideration, without getting a immediate deduction of the cost that the shareholder has incurred in the first place. As against that, the shareholder is now allowed to carry forward uh, that cost that he incurred in the first place in form of a capital loss. And capital loss, as all of us are aware, is allowed to be set off only in limited situations and can be carried forward only up to 8 years. But this is how the new buyback law is proposed to be introduced. We'll turn the page and look at some of the other rationalization measures on the assessment and reassessment side. Reassessment has been one area which underwent significant changes in the last couple of years. Conventionally, there used to be a 4 year and a 6 year timeline, beyond which reassessment could not have been done. There was a 16-year timeline as well, but which was applicable only in very, very stringent scenarios. So, by all means, it was only 4 years and 6 years earlier. And a couple of years back, they changed it to 3 years and 10 years, which significantly changed the gamut of coverage, because tax authorities suddenly had the handle to go back right up to 10 years. And again, in the first year when 10-year limit was introduced, it was quite curtailed in its scope, which got enhanced in the subsequent cycle in the next following budget. So overall, there were a lot of tweaks that were done to reassessment regime, and now we are told that the 3 years and 10 years regime will go and will conceptually be replaced by 3 years and 5 years regime. So this is a good sign, because it makes us think that the government has been giving a thinking to all the representations made by different taxpayers, because keeping the time limit for reassessment open for too long also gives makes things very uncertain from a taxpayer point of view, and therefore reducing this time limit, I think, is a clear welcome step. So that is one thing that has been done. This also directionally gives us a view as to how things are likely to continue when the either the new direct tax code or the new income tax law, whenever after 6 months the finance minister and the committee reviews it, how directionally they are thinking. So it is likely that some of these things are also keeping in mind how they want to shape up the new income tax law, around ensuring that there is enough certainty and simplicity from a overall governance point of view. The other part that is proposed to be rationalized here is you know for delay in deposit of TDS after deduction. Previously, the moment there is a delay, it was always open for a potential prosecution proceeding, and sometimes delay of 1 or 2 days also were getting caught in the system. But that obviously wasn't the objective of those provisions. So there is a welcome amendment there to clarify that no prosecution proceeding for non-deposit of TDS will be initiated as long as TDS is deposited on or before the date of filing of the return for that quarter. So that is a welcome amendment. There is rationalization done on time limit for filing of appeal. Then there is some welcome rationalization on monetary limit for filing of appeal by the department. And this is also to contain the number of cases that really go into the entire backlog of cases that no India really has as a country. Now, income tax tribunal, we don't have pan India, a lot of cases which are pending because not many cases are traveling to ITAT because CIT appeals as a forum has not been functioning very smoothly, or a lot of disposals were not done in the last 2 years on commissioner appeal. So no, that's another lens, and there's another provision which is proposed which will come to. But overall, this is a welcome amendment to see that no monetary limit for filing of appeals by department across ITAT, High Court, and Supreme Court has been increased. We'll turn the page and look at the point that I was referring to, Vivad Se Vishwas Scheme 2024. Uh, the scheme obviously sounds familiar because the same scheme was launched in 2020 and was a huge success at that point in time, because it did give government a significant headway in improved tax collection, and at the same time it gave taxpayers a window to really settle cases which were getting dragged for too long, and cases where taxpayers believed that they don't want to, a for want of better merits, or for want of resources to keep fighting, they preferred settling those cases. So based on similar design, new scheme is proposed to be launched again. This will after the finance bill is passed, and this scheme will have more contours, FAQs, etc. will be announced, but largely it is modeled on the same premise as the earlier scheme. There is a incremental cutoff and an extra 10% tax that one ends up paying, or 10% or 5% tax that one ends up paying if this dispute was no on or before the earlier VSV date of 31st Jan 2020. Because if it is before 31st Jan 2020, then it could have been covered in the earlier Vivad Se Vishwas scheme as well. And if taxpayer didn't choose to cover it then you have to end up paying no a slightly extra tax on that to settle that dispute now. But by and large, the design principles are common. We do believe that there will be guidance issued, FAQs issued, and conceptually the design of this scheme will continue to operate in a way that forms will be prescribed. Taxpayers will end up filling forms, submitting those forms to the respective authorities, designated authority. Designated authority will, within the specified time limit, review the application, review the grounds, etc., and map the entire application within the contours of the scheme. And if it is found to be within the four corners of the scheme, that amount will be allowed to be settled and the dispute will be completely closed. So we expect this to go on similar lines. There are representations made on Vivad Se Vishwas again to ensure that no different scenarios which don't apparently seem to be covered now, which were again in the previous installment, also were clarified in some of the incremental FAQs that were released. One hopes that some of those points continue and more aspects are clarified. We'll turn the page and quickly look at some of the rationalization measures on TDS and TCS side. So a lot of changes done on the rates. Again, the objective here was to make the TDS provisions a lot more simple. it doesn't appear that a lot of simplicity got added to the TDS provisions as such, and one hopes that the simplicity really comes in when the finance minister reviews the entire code a couple of months later, because conceptually what is done here is for various sections which previously had a 5% rate, it is now proposed to be reduced to 2%. So we don't see a drop in number of sections. In fact, one more section got added, with respect to TDS on payment to a partner by the partnership firm. So that, in fact, is one more TDS section now to comply. But conceptually, apart from a reduction in rate from 5 to 2%, and 194F, which is now omitted, there are not material changes on the rate side, especially on the TDS. And most of these changes are effective from 1st October 24, except for 194T and 194F. So we'll turn the page and look at some of the other rationalization provisions. There is a clarificatory amendment on 194C interplay with 194J to say that any sum referred to in 194J will not constitute work for the purpose of 194C. No, again, no, this is more clarificatory in nature, so I'm not getting into the details. The other amendment proposed is on clarification around how the monetary limit of 50 lakhs should be computed in a 194 IA scenario. 194 IA, as most of you know, applies when you are buying a immovable property, and if the immovable property is a transaction has too many buyers or too many sellers, or more than one buyer or more than one seller, should the 50 lakh limit apply qua buyer or qua transaction? So the clarification is that it should apply qua transaction, and that's how the uh, and that is the only limit that one should use, and not use it separately for each transaction as such within the same immovable property. The other important amendment is time limit to revise TDS returns is now capped to 6 years. There was no time limit earlier, which means that for companies which have been in existence for long, there is a real possibility that you may end up carrying a unutilized challan from a TDS perspective, which may be more than 6 years old. So effective, a couple of months later, this will no longer be available to you, and therefore important for you to ensure that if there are unconsumed challans lying, then one needs to find a way to roll them over to the subsequent period and ensure that you utilize it, because after this amendment comes into play, you will not be able to revise the TDS returns, which are more than 6 years old. Yeah. Sorry. Then there are some rationalization provisions on treating a person as a assassin default in case of non-residents. Previously, there was a provision only for residents, and the limit was 7 years. Now, non-residents are also being covered, and the entire time limit is 6 years. We'll turn the page. Quickly covering some of the last amendments, and these are my last two slides that I want to quickly cover. Angel tax, which has been a subject matter of great criticism in the last couple of years, where an Indian company raising funds from overseas, and if it is issuing shares at premium, and if the premium is beyond the fair market value, then there was a tax that was being calculated. So that is now proposed to be abolished. 194Q was introduced, and a lot of compliance burden got added on the taxpayers a couple of years back, but there was no provision to to get a lower or nil TDS or TCS certificate for that. And that enabling provision is now proposed to be made. The other amendment is with respect to transfer of assets by way of gift between corporates. There is a specific provision today, Section 47(3), which treats such transactions as non-taxable because it is regarded as specifically exempted from the definition of capital gains. That definition has now been tweaked, and the such transfers by way of gift between corporates will no longer be held to be non-taxable. There is increase in STT rates on F&O. I'm not getting into the rates, but that's another important amendment that no one sees. We'll turn the page. And no, the last two amendments that I want to quickly cover here is on treating income from residential property under house property, income from house property, and There have been cases where companies have explored taxing it under profits and gains and business profession and take other deductions as well beyond the standard deduction of 30%. And that seems to have been clarified now that such income should only be taxed under income from house property. The other clarificatory amendment is any amount paid for settlement of any contravention under any law should be disallowed under section 37. This was by and large already in place, but looks like it is clarificatory and really expands the horizon beyond the previous coverage as such. So these were some of the critical amendments on the income tax side. I will take a pause and hand it over to Neeraj to walk us through some of the indirect tax amendments. Neeraj, over to you.
Thank you so much, Manoj, for this. Yes, we can go to the next slide, please. So under the indirect tax, if you typically see, we would see that there are a lot of amendments that has come under the customs as well as the GST. While we all are aware that generally the amendments under GST do come through the GST council meetings, but we did see quite a few bit of amendments that we proposed, which is more benevolent or beneficiary to the general industry. To start with, let's see, this particular section 74 has been introduced. I'll not get into very detail or dynamics about it. I'll just tell you what are they intending to do here. Until now, all your assessments or proceedings, what were either happening under section 73 or 74. 73 is for cases which does not entail any fraud or willful misstatement. And under 74, it did entail fraud or willful misstatement. So the proposal that has been brought up right now is from the financial year 24-25, both 73 and 74 will be done away with, and there'll be a new section of 74A which is being introduced. What they have done is they have brought in a common timeline in terms of issuing notices, which is 42 months from the annual return due date. So if you have to take some dates, so let's say 24-25 financial year, this current financial year, the due date for filing the annual return is 31st of December 2025. From there up to 42 months, they can issue you a notice. And from that date, they have another 12 months to pass an order, which can be extended by further 6 months. So this is the overall timeline that they have brought in. Under this one section only, they have brought both cases of one which is entailing on account of fraud or willful misstatement, and one which is other than on account of fraud or willful misstatement. So this is what they have brought in. What they have done is that they have bought staggered penalty provisions also, to say that if you are ready to pay the tax liability with interest before the show cause, then the penalty should be X percentage. After show cause within 30 days, before order, after order within so many days. So they have brought this staggered level of penalty, which in one sense is probably good, because earlier we always had this risk of always being faced by a penalty of 100%, also at 15 or 25%, depending upon which section it is going. So they have just introduced more staggered payments here under this particular section. That's the proposal that we have. One good thing about this is, for all those who are aware of GST, what used to happen is if you're paying any taxes because of a proceedings which is initiated by the department, and if the taxes are paid under section 74, which is on account of fraud or willful misstatement, you were not allowed to claim the input tax credit. This was a provision which is still there under the law. However, that amendment to that particular section, which is section 17 subsection 5, they have removed it, which now probably means that even if the liability has been paid by the taxpayer on account of fraud or willful misstatement, it looks like the government is saying that you will be able to claim the input tax credit on such payments also. This is what the proposal seem to indicate. We'll have to wait for the final amendment to come, the presidential assent to come, and finally we'll have to see how the wordings turn out to be. Personally, I feel this might go on under change, or it is too good to be true, because if there's any proceedings under which the tax is paid on this, and if genuinely the input tax credit is then made eligible to the taxpayer, it's a huge welcome amendment for us if we really see. So this is one of the proposed amendment that we have. We can move on to the next slide, please. Another welcome amendment is it says for all the previous tax years periods, which is from 1st July 2017, that's the day when GST got introduced, till 31st of March 2020. If there are any proceedings which got initiated under Section 73, and if the taxpayer is okay to pay the entire tax liability, then it says any interest or penalty which has become due will be waived off. So this is more like an amnesty scheme that the government has sort of intended to introduce. Of course, if there are any appeals filed, they have to be withdrawn, and you cannot appeal against this matter again at a later point in time. So they will be bringing a lot of conditions. We'll have to wait to see how does the actual amnesty provisions and rules come into play as and when they are probably been introduced. But until then, I think the way it looks like, it's a welcome change, and a lot of this small amounts are for which the penalty, for which the appeal has been filed more because of the interest and the penalty provision. They'll all benefit because of this one proposal. As I said, we'll have to wait for how the amnesty scheme comes into play, what conditions it comes with. We'll have to see that in greater detail. I think this is just like a procedural amendment in terms of pre-deposit that is required while you file an appeal. So if the disputed tax is, let's say, 100, then it says you need to pay 10% of that amount as pre-deposit for the first stage, and then 20% at the second stage. So this is how the provision was. For us, let's just understand the maximum amount that was otherwise required to pay was 50 crores, which is 25 crores under CGST and 25 under SGST. That has been brought down to 40 crores, both at the first as well as the appellate tribunal stage. I think for us, this should be a proposal which is, to be understood. If there are any questions on this, happy to take them, but I'm just keeping it very simple for all of us right now. We can go to the next slide, please. Okay. This particular section 11A, this has probably been introduced, to empower the GST Council to actually see if there are any issues that is there on account of a non-levy or a short levy, and which is an industry issue. Then what it does is it is empowering the GST Council to probably make changes or bringing amendments so that it benefits the overall industry and not one single player in particular. So some of these classic cases, what we had seen is that all of a sudden, in a peculiar situation, let's say where there's a foreign MNC and somebody from that country has come down here to work for a period of 12 months, 18 months, 24 months. There was some GST implication that arose on account of that there's a Supreme Court judgment because of which all of this happened, and which was a complete industry issue. So in such cases, they have probably made changes, brought in circulars, and they have tried to work it out where it benefits the industry at large, for which they have said that they have sort of introduced an empowering section to the GST Council to address these issues. Needless to say, it cannot be an issue which is very specific to a client, but generally what's been followed. So this is again more like a proposal just to empower the government to waive taxes. Other proposed amendment is input tax credit, they say, for any period from 2017 till March 2021, whatever input tax credit is there, it says a maximum time limit to claim the credit, irrespective of the period between this. So even if it is for 17-18, however, if you have claimed the input tax credit of that period before 30th of November 2021, then the proposal says that the input tax credit will be allowed and it will not be denied. So earlier, if you see, we had time limit of 8 months. The initial year we had time limit till March 19, which if you see because of this proposed amendment will extend to 30th of November 2021. So a lot of the people who have claimed the input tax credit after the due date, their matters are under litigation. Now, because of this proposed amendment, this will probably work in their favor. Unfortunately, if somebody who is an honest taxpayer has paid that liability, that amount cannot be now refunded back. So in one sense, if you look, anybody who's been pretty honest to pay this taxes earlier is standing to lose, while somebody who fought it and claimed at a later point in time, even beyond the due date, it looks like probably they'll benefit because of this proposed amendment. So this is what, however, if you look at overall industry experience and practices that's going on, this is definitely a welcome change that has been brought in, or been proposed to be brought in. Other amendments are in terms of transitional credit. There's some amendment that they have brought in, especially for the ISD related invoices that was probably introduced as of 30th June 2017. Very peculiar situation. I think I'm not wanting to go into detail. If there are questions, maybe happy to address them as we proceed. Another amendment was in relation to reverse charge liability on unregistered suppliers. So, for example, if you take an example of a GTA today, chances are that your transporter is not registered. So, if in such a case, if he's raising an invoice on you, then this question always arose as what is the time of supply for such services? And they have said it will be earliest of the date when you make the payment to them, or the date on which you have generated a self invoice. Now, what is important to note here is the document for which, the document basis of which you are eligible to claim an input tax credit is this self invoice only. And a lot of time it has happened in the past that, let's say for the year 21, 22 or 22, 23, you would have missed to pay any reverse charge liability, which you have probably realized today. So industry or taxpayers have generated an invoice today, paid the reverse charge liability, also discharge interest because there's a delay. However, they have claimed the credit basis what the invoice they have generated today. This, a lot of people have done the industry, and because of which, they have brought in various circulars also, which is permitting to claim the input tax credit basis the date on which the invoice was generated. And the department was always litigating this. But this again is a welcome change. The only catch here is they said that they will notify what is the time limit within which your self invoice has to be generated. Now, there could be a lot of examples. Let's say there's an invoice, which is from an unregistered dealer was pertaining to March 24. But however, you have not raised a self invoice and you probably intend to raise it in October, November. You can actually claim the credit from in the month of October or November, assuming that's the period on which you have claimed this, or you have raised in self invoice and you have claimed the input tax credit. Interest is going to be a cost on that. But the only catch, as I said here, is once we get to know what is the date that's been notified, accordingly, it might really change the whole scenario, and which is something that we'll have to wait for, because the date by which the self invoice has to be generated is yet to be notified. Another procedural amendment is as and when the GST Appellate Tribunal, that is GST 80, GST Appellate Tribunal will be notified. From that day, you will have 90 days to file the appeal before the Appellate Tribunal. There would be chances where there's a proceedings which would have got initiated, an order has been passed, you have challenged that order before the first appellate authority. However, that also has not gone in your favor and you're waiting for the tribunal to form. So this date is something we'll have to look out for. The moment this gets notified, you will have 90 days to file all your other appeals as well. So it will be worthwhile noting this and start preparing for that. Another good amendment is authorized representatives are allowed to appear for summons before the officer. So what happens here is that a lot of time we have seen that they issue the summons in the name of the directors or the CEOs of the companies, and the matter gets escalated in no time. All of a sudden, the director sitting somewhere else is getting a notice for them to come down for a summons, where the basic information is only called for. They'll call for your balance sheet or tax returns and registers. So there, somehow the department or the GST Council has realized this to say that it will be okay if even if summons are issued in the name of a director or a company or let's say CEO, an authorized representative can go and he can actually, prepare the submissions and, probably record a statement. Only word of caution here is whoever you're authorizing should be in a position to record a statement on your behalf. To give a classic example, if the notice were issued in your name and you have authorized a chartered accountant or a tax consultant to go and represent yourself, if there is a statement which is being recorded, whatever the consultant says could be binding on you. So there, we generally are suggesting that in such a case, you could also authorize your employee who understands your business well and who can go and record a statement. while the consultant can always accompany basis to give a little support on account of a legal framework. So these are some things that they have brought in, which is sort of a very welcome amendment here. And we go to the next. So this is under customs. I will not go too much of depth into it. So primarily, let me tell you, the finance minister in last 2 or 3 years budget also, they have said that whatever notifications are being issued since the beginning, almost like 4 decades and 5 decades old, these notifications, these exemptions are something that they are going to rationalize them. They are going to review them, and whatever are not applicable is something that will get phased out. So this exercise has already begun, and under custom, there are probably around 10 to 15 different rates. They intend to consolidate all of this and bring into 4 or 5 different rates. So that process of rationalizing of custom rates is anyway undergoing even as we speak. What they have done is they have reduced the custom duty rates on those particular industry where they want to promote the domestic market. So if, for example, if it is in relation to electric vehicles manufacturing, if there is a dependency on a certain product which has to be imported because it's not available in India, looks like they have gone ahead and exempted those particular products from customs duty. It could be very critical minerals. It could be, on some specific set of goods as well. So this is something that they have done. And at the same time, where if they want to protect the domestic market, they have levied higher rates of customs duty on those imported goods as well. So overall, the whole idea was to enable more Make in India, rationalize the customs duty rates also, so that, the taxpayers, the industry players can get a good playground for them to import goods at cheaper rate, where they are going to think of more of greener economy or electric vehicle sort of a space. Or if you are looking that that's going to hinder your business, then the custom duty rates have also gone up. I'm not going into too much of detail here. Neha, you could go to the next slide, please. So yes, comprehensive review of rates is again proposed, as I spoke some time back. A lot of exemption notifications, their validity is something that's going to be reviewed, and they'll be phased out as time progresses. Some trade facilitation measures which are effective immediately, that is 24 July, were like welcome change. So if an aircraft or vessel has probably been imported for maintenance, repair, or overhauling, they were earlier required to leave the country within a period of 6 months. That has now been extended to a year. And also, if you are exporting certain goods, and if they were to be brought back under warranty for any job work or anything, the period was only 3 years. Now they have extended to 5 years. Now this is a welcome change. So today, if you are exporting any goods in the global market, you can give them that comfort to say that even if something goes wrong with your product, under warranty, you're okay to import it back into India within a period of 5 years now, and sort of give that warranty, which gives great confidence to all the global players out there when they are importing goods from India in their country. So another welcome change. Um, these are all procedural. I'm not going in depth. This is more to do with if you are importing certain goods from a specific country, the custom duty can be at a reduced rate because of free trade agreements. I'm not getting into the details. If you have questions, happy to take them. Similarly, under what goods can be permitted to be stored, and something which is ineligible to be brought into a manufacturing and other operation warehousing regulations is something that will be notified. And these are some tariff entries that probably under the first schedule, which will be effective 1st October. Again, I'm not going into detail. We could go to the next slide, please, Neha. Yeah, I think this is what I had to generally cover here. Just exactly 5 minutes to 5, as probably Rakesh, you wanted us to probably cover this. I'll take a pause here, and if there are any questions, happy to take them.
Thank you, Mr. Menon and Mr. Rafi, for your excellent presentation. I don't see any questions in the chat box, but I have some questions. I think Mr. Rathi has some other meeting at 5 o'clock, so I will just ask him first. Out of what are the presentations you have made and what are the announcement in the budget, or what you think was the highlight, are the point should be noted by the manufacturing sector, because that has big implications for them. Starting with Mr. Rathi.
Sure. So, Rakeshji, two important highlights. Again, more from tax announcements. See, whenever we analyze budget every year, there are some winners and there are some losers from the proposed amendments. But what are the two important pillars of this budget? One is MSME because of the ecosystem support that that the government is really trying to create. And not that this is the first time that it is being created, but in my view, it is being significantly strengthened. So within the manufacturing space for the MSME, I think that becomes a very, very niche area for companies to start exploring those specific benefits, whether it's interest rate reduction, credit access, and stuff like that, some of which we briefly covered earlier. So that I think is an important highlight. The other important highlight which I would encourage companies to explore across the board is on the benefits, both some fiscal benefits, and some of them are available to the employer and some of them are available to the employees on the employment linked schemes that they've really announced. And then on specific direct tax proposals, there are some important highlights, but again, whether they'll impact everyone across the board, no, it's not the case. It'll depend on companies who have those specific facts in the matrix, and that's when some of the tax amendments will be relevant. But these two other aspects, one on MSME benefits and the other one on employment linked schemes, I think these will apply across the board for manufacturing sector.
Mr. Menon, specifically to you, we have heard even the Commerce Minister talking about lowering the tax barriers or customs duty, especially when we are talking free trade agreements with other countries. And also we are talking about rationalizing the customs duty, just like you mentioned in your presentation. My question is, what is your take on this? Because at the end of the day, if you lower the customs duty, there will always be domestic manufacturer who will be complaining about, competition. And on the other side, the user of that particular product who want to value add and sell it back to or export back, he will be happier to have a lower customs duty. So how do you, balance it out?
So I think what the government has been very keen on focusing and consistently trying to, uh, sort of instill deep down is that they are very keen on ensuring that the Make in India is taken up to another level. So by that, what they mean is even if you see a lot of this policy announcements or even budgets that's been allocated, let's say especially to an automotive sector or let's say new energy space, where even the MSME might have some interplay. So what they're trying to do is they're trying to create really good global players. And while they want to do that, and they want to really be, the China plus one policy, if you see, and really want to give as much as benefits or support or infrastructure to this particular sector, what they're doing is, if to bring India to that level, if it requires the government to ease onto certain trade facilitation measures, bring down on the rates, improve or ease the free trade conditions, benefits, conditional benefits that's been given, they are working all of that. While, as you rightly mentioned, at the same time, if they feel that because of a certain product, if the uh, uh, if, for example, the domestic market is being probably hit because of that, then they are going ahead and introducing safeguarding measures and anti-dumping duty and so on and so forth. So they are taking absolutely an industry call. The overall focus, if you see, is also to see that they want to create very niche 5 or 8 very strong sectors which can be which can address a lot of issues globally. So it could start with an auto. We have seen auto sector coming in. Then we have green hydrogen and ammonia that came in, which is a new energy space that came in. We had textile PLIs also what the government introduced. Now they are talking of introducing PLI sectors for toys also, right? So what they want to do, they want to create such niche areas to say that, so for example, when the toys production link incentive schemes will get introduced, if there's a raw material which is very important for those toys to be manufactured, for all you know, the government will go and reduce the rate because it's not available today in India. However, if because if I import a finished goods directly from China, and that will really disturb the overall economy in India, what they would do, they would go ahead and increase the rate on those toys which are being imported from China or any other place for that matter. So this is how they are constantly working. There could be a delay in some stuff, Rakesh, but eventually, if the industry brings it to their attention, primarily it looks like they will do things which will favor Indian taxpayers and industry itself.
Okay. So thank you. With this, we come to an end of today's program. I would once again thanks Mr. Niresh Menon and Mr. Manoj Rati for sharing their valuable insight on such an important topic of budget. And we would also like to thank our participants for joining us for today's program. And we would also like you to join us for our next webinar, which will be tentatively scheduled on the September 6th. Till then, thank you, everybody, and have a great day. Thank you.
Thank you so much for having us. Thank you all.
Thank you.
Thank
Thanks
you.
a lot.
Thank you.